and welcome to the next instalment of our Bond Monthly newsletter. As always, the purpose of these is to give a brief overview of financial markets. So, what's been happening recently? Well, this week we have a plethora of economic stories to pick through, from inflation and labour force data to a more volatile stock market, to say the least. So first of all, I'd like to start off with some positive news, finally. Over in the US, inflation rates fell quite significantly on Tuesday, which really boosted markets. Good news for the wider economy. The S&P actually rose about 3% over the last 5 days, so far so good. Closer to home, was in the UK, inflation has now fallen to 4.6% in October, down from 6.7% in September. Its lowest level since 2021, which, as we can all agree, I'm sure, is some fantastic news. On top of this, we also saw wage growth of 7.7% yesterday, which, considering the low inflation numbers we're witnessing, now means that we are now seeing some real wage growth finally coming back to the UK, certainly over the last few months, bearing in mind the low inflation numbers that I've just stated. Of course, it may not feel like that for everyone, and is certainly not universal amongst all sectors that people work in. But in aggregate, for the whole economy at large, wages are now growing faster than inflation. So good news there. So that is in general, a feel-good economy that we're now living in. And with all this, however, there are of course lots of moving parts and caveats to the wage rise statement. It does of course depend on the area of the market that you're working in. The inflation figure was a lot better than expected, certainly a lot better than what some pundits were expecting. And core inflation, which of course strips out both energy and food prices, fell to 5.7% from 6.1%. While the service sector inflation also fell by more than the central bank, the Bank of England, had expected, to 6.6% from 6.9%. Rather more modest reduction there. But overall, we are now getting a lot closer to the Bank of England's 2% target, and only time will tell if we ever get to those types of figures, hopefully sooner rather than later. Some also really positive news: we also got a pause in interest rates last week, so the question remains, have we seen the end of the rate hike cycle, and will we even start to see the potential rates to start falling soon? Wait to see if that happens. The Bank of England went off-piste somewhat by taking growth forecast down to 0.1% as an expected growth rate. And this is, of course, below what the OBR and the IBF had. We know, however, that it takes at least 6 months before data starts filtering through from higher interest, for example. So we'll have to wait and see on this front. The market, however, has now perceived a rate cut which might come in September and autumn of next year at the earliest, according to some pundits. So good news there, but we will have to wait a little bit while before that actually starts kicking in. Over in America, Mr. Powell suggested that they have no immediate plans to cut rates at all. So what does this actually all mean in practice? Well, of course, rising or falling interest rates can have an impact on the psychology of investors. When the Federal Reserve announces a hike, both businesses and consumers will cut back on their spending. This will cause earnings to fall and stock prices to drop. The market may then tumble in anticipation, or it may, however, go the other way. If they're anticipating a rate cut, markets may become more buoyant. Investors may also revert to what's called safe asset classes. What do I mean by that? Well, I mean cash or money market funds, which are equivalent to cash-based investments, or bond holdings, rather than investing into riskier assets such as equities. These safer asset classes become more buoyant as interest rates increase. Indeed, even savings accounts now are offering up to about 4 to 5%, and even more if you choose to lock up your money for a period of 1 to 2 years, for example, which is a pretty attractive place to be, certainly considering where rates were even a couple of years ago. So you can see, given this backdrop, that markets have been rather muted of late. One pundit recently even suggested that it's not about making money in this economic environment, it's about not trying to lose money. Possibly easier said than done. So due to these kind of many economic headwinds, such as high interest rates, high inflation, cost of living crisis, and 2 wars going on, we have now essentially been in a bear market, i.e. markets falling, since around November 2021. However, it's important to note that with bear markets and market cycles, bear markets, they don't last forever. They typically last between 1.5 to 2 years, or thereabouts. And of course, I'm not suggesting that things are going to improve dramatically anytime soon, but there is a point where markets get so slowed down that they can't really fall much further. And in fact, that becomes a good buying opportunity because stocks and companies become cheaper to buy into. Hence, market cycles. Where we are now, we can't see interest rates increasing by any further than they are. They might by 0.25%, maybe. But this really comes down to the amount of pain they are inflicting in wider economy. Can the economy take much more before real cracks start to appear and the market falls apart, i.e. we go into a recession? Some pundits are saying that we might go into a mild recession early part of next year, but I do stress mild. So, of course, it's always dangerous to set up one stall based on these scenarios, and of course we must remain vigilant in these tough economic times. As always, we'll continue to monitor the markets continuously and make adjustments to the portfolios as necessary. Should you wish to discuss any of these points in further detail with myself, please do get in touch. Thanks for listening.